Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast. Now, peeking into the lives of the super rich, for most people is quite interesting. I'm one of those people as well. I like to see what they do and what they get up to. But you don't normally get to see how they invest, where their money goes. But in this episode, we will reveal how they actually invest.
Welcome to the Property Podcast. It's a Thursday morning, and that means we're taking time out from advising a multi-million-pound property fund, which you can find out more about at portfolio.co.uk, and sharing some of the knowledge and perspectives that we've gained along the way for free. Yesterday, we're giving you an exclusive glimpse inside the investment portfolios of some very wealthy people. It's going to be a lot of fun, and there's going to be a lot to learn from that as well. So that's coming up, and make sure you stick around to the end, because we're going to recommend a resource that's going to make you a far stronger communicator. Before we get into all that, quick check. You are following the show, right? If you're not, you can put that right in about 2 seconds. On Apple Podcasts, just hit the little plus button, or on Spotify, you can hit the follow button, and that'll make sure you never miss an episode. There could only really be one news story to focus on this week, which is that the Bank of England is back in action, and they have increased interest rates by 0.5%, which now takes the base rate to 1.75%. By historical standards, of course, still extremely low, but after the last 15 years, a bit of a shock to see it nudging up towards 2%. This, of course, in property terms, means that mortgages are likely to get a bit more expensive. How much more expensive, we're going to have to see, because as we often say when we're talking about this on the podcast, the base rate is a factor, but their desire to be competitive and win business is another factor. So we'll have to see where those rates land. And the other question, of course, is what does this mean for the property market in general? You might expect rates increasing to affect property prices. Also included in the Bank of England's update that talked about why they did this, they talked about how they now project that inflation is going to hit 13%. And so that, of course, might also put pressure on how much people can afford to pay for their housing. Well, we're going to dedicate next week's episode to just that question. Is the property market slowing? That's what we're talking about next week. So you'll definitely want to join us for that one next Thursday.
If you are a Property Hub magazine subscriber, then you are in luck, because you're about to be emailed a UK property investment location guide. And this isn't a one-pager. This is a wonderful, wonderful document that's taken ages to put together. It's been a huge piece of work from our talented editor and her team of writers over at the Property Hub magazine. And not only is it stacked full of information, it looks beautiful as well. So it's a real freebie. You didn't know you were going to get it, but it's going to be emailed over to you very soon if it hasn't been already. So do enjoy it, and please let us know what you think. If you like it, we can do more of that in the future. But if you're listening to this and going, oh my word, I'm not signed up to the magazine yet, then get yourself subscribed, because it doesn't matter when you sign up, you will also get that free guide. So not only is it incredible value at only £5 per issue, but now you get this incredible guide to the best UK locations for property investment. So head over to propertyhub.net/magazine to get signed up if you're not already.
Quick reminder before we get into the rest of the episode that our app Portfolio is now open to all. Previously, you had to join a waiting list and patiently wait for your turn to come around. Well, no more. Now you can go onto the App Store, download the app, and be using it right away. And the minimum investment we've also reduced to £1,000. Which is something that we're so excited about, because our whole vision with Portfolio was to open up the benefits of property investing to as many people as possible. So if you want to find out more about what Portfolio is, then you can go to portfolio.co.uk. If you're interested in getting rich and you go and see a financial advisor to help you, what are they going to tell you? They'll probably say that you should be saving as much money as possible and investing it in some combination of stocks and bonds. And the allocation between stocks and bonds is going to depend on your risk tolerance, your age, and things like that. But that's going to be the core of what they tell you to do. But if you look at people who've already made it, they've become rich, does that match how they invested? Or did they do something a little bit different? Well, in this episode, we're going to break down what very wealthy people invest in and what lessons you can learn from it for your own investments.
Let's be clear from the beginning. This isn't based on our opinions. This is data from a really useful source. It's a wealth network group called Tiger 21. And to be a member of Tiger 21, you need to be worth at least $20 million. And with our exchange rate at the moment, that's like £19.5 million. So a sizable sum of money. And remember, that is the minimum criteria. There's going to be people in that group worth a lot lot more. And this network spans across the world. It's not got just US members. So this is a worldwide survey, even though the investment amount is in dollars. So after surveying their network, what are the results? Well, the results are really interesting because, as Rob's already said, there is a perception out there of what you should do, and there is a perception out there of what the super rich may do, but we have the hard data.
Okay, let's whip through the average asset allocation of these very wealthy individuals and families. So about 5% is made up of hedge funds, currencies, and miscellaneous. So you can kind of put that to one side. Then what you're left with in ascending order is fixed income. So that's bonds. That makes up 7% of their portfolio. Next up is cash and cash equivalents, 13%. After that, you've got private equity. So that's basically investments in businesses that are not traded on the stock market. That's 22%. After that is public equities. So companies that are listed on the stock market, 25%. And topping the list, 27%, real estate or property, as we might call it. So actually, Rob, to really simplify it and take out all the little bits, it's kind of divided into fairly equal quarters. You've got a quarter of cash and bonds, a quarter of public equities, quarter private equity, and quarter real estate.
So that's the state of play, but let's get into why this is the case and why this allocation is as it is. I mean, 13% of that is cash or cash equivalent. And some people listening might be like, wow, that is a big contingency fund, right? Because that's what you're told to do with cash. The only cash you hold is for a contingency, a rainy day. You know, you shouldn't save, you should invest. But then here's the super rich, and 13% of their wealth is for cash. But I'm not completely surprised by this, Rob, because if you're going to invest and if opportunities come around, you want to have the ability to transact. And having cash put aside, having the ability to move quickly is probably really valuable to this group of people. Because if opportunities come along that is really, really strong, you don't want to be passing on them. You want to be, snapping them up, and having cash available to do that is worthwhile. Even though it may be costing you by holding cash because of inflation, it's still worth that risk and that cost, because the upside potential of a strong deal coming along is probably better overall. At least that's my interpretation of this. But what do you think?
Exactly. I think this is the first example we're coming across of how the way that the rich actually invest is completely different from how you're told to invest if you want to become rich. Because what you're told to do is drip feed everything into whatever your chosen mix of investments is on a monthly basis. Pound cost averaging, it's called. So you're making regular contributions all the time, no matter what the market's doing, because you're not trying to time the market, you're not trying to be too clever, and you end up doing far better on average than if you're trying to be too smart. And that is, for a lot of reasons, sensible advice, but it's absolutely not what the wealthy do. From speaking to people and listening to people who do have significant amounts of wealth, what we're seeing in these results here mirrors my experience, which is they do have a lot of cash sitting around waiting for the right opportunity. Part of it is just the fact that maybe they're in a position where they're generating so much cash from their business or however they made money that they can't get it out the door fast enough. And so there is just cash sitting around for that reason. But a lot of it is, like you said, Rob, is opportunistic. They're not just drip feeding on a regular basis. They are being opportunistic, they're being strategic, they're waiting for the right investment to come along. And when it does come along, they pounce. They're ruthless. They don't hesitate. They're on it. But if there isn't a great investment there, they'll very happily do nothing and just have the cash sitting there.
What's also interesting as well is how unexotic, is that even a word? I don't think it is, but unexotic this portfolio is. Because things like currencies, holding different currencies, and commodities are only 1% each. Besides private equity, which we'll come to shortly, the rest of this portfolio, the remaining 75%, is fairly steady, safe stuff that most people have access to, if not all people. So the lack of risk in this wealth allocation, I think, says a lot as well. But again, it's understandable, because if you've created this wealth, a lot of people want to increase it, but also preserve it. They don't want to bet it all on black or red down the casino. They want to make investments that over time, it's shown that they perform over the long term. We'll come to private equity in a moment, but I think what's glaring here is, of the steady stuff that you'd normally expect people to invest in, public equities, or stocks and shares as most people will know them as, is only 25%, which is very different to most people's wealth allocation. The normal person, anybody who's got a pension of any sort, any sort of wealth accumulated, whether it be big or small, Normally, you're told, put it in stocks and shares. And there may be different ways you can approach that, but the super rich are only allocating 25% of their wealth to public equities. Rob, why is the advice to the everyday person one thing, and we're told to do something and we do it, most people anyway, they do that, and then we see what the rich actually do, the people who've made it, acquired wealth, have proven they understand money and have got to that point and are now trying to make more of it. Such a disparity. Like, it's a huge difference of what the normal person does and what the super rich do. So, easy question for you. Why is that?
Well, here's my opinion. I think it's because in the public markets, they don't have an edge. It's like the same investments that everyone else is exposed to. In private equity and property, which makes up half of the allocation, you can have an edge. But in the public markets, you've got the same investment choices as anyone else. You don't have any kind of special status. You can't get into investments that other people can't. And for that reason, I think the public markets just aren't that exciting at that kind of level. For most people, stocks and bonds are the only investments that they can get access to. Either because of regulatory reasons, there's some things you can't invest in unless you're at a certain level of wealth, or because of connections or knowledge or time or whatever. So your universe of potential investments is smaller, but these people have more options and they're taking advantage of those options. If you look at public equities plus fixed income, so bonds, that only adds up to a third of their portfolio. So 100% of what your financial advisor would probably tell you to invest in only makes up a third of what they invest in. And I think, Rob, there's two ways you can look at this, and I think it's probably a bit of both. You could say, well, look, of course, these people have got more wealth, therefore they can take more risk. So kind of in a way, even though the stakes are higher, the stakes are lower, but they're never going to end up running out of money in retirement like you might if you get it wrong. The other way of looking at it is going, well, these people have got the knowledge and the connections and everything else to have access to more investment, and they're choosing to make use of that by investing in things that most people don't. Therefore, that tells you that the kind of stuff that most of us are told to invest in, and those are their only choices, actually aren't all that exciting.
So let's get into the biggest chunk of allocation, which is real estate and private equity. So real estate, as a reminder, 27%, the largest allocation, and private equity at 22%. So private equity businesses, investing in businesses. I'm surprised private equity is as big as it is, but I'm not surprised that it's one of the biggest. And it's also interesting that they're close, 27% and 22%, because you've got one which is seen, at least in my eyes, as riskier, which is private equity, and you've got one which is seen as safe and secure, real estate, property investments. And actually, they operate as a bit of a balancing act. We've talked about multiple times on the podcast how you can create wealth through businesses, and then any wealth that you create, you should put into property. Or that's our belief anyway, and that's obviously what we've done. Now, this isn't a unique concept to us. We've talked about the millionaire fast lane. Rich Dad, Poor Dad's talked about this concept as well. It's not a new concept. There is information out there beyond what we've given on the podcast that talks about this. But this is it playing out in real life. It's one thing to read a book on it. It's another thing to listen to us rabbit on about it. But here's the evidence that it's actually what the super rich do. They are putting money into businesses, which is a riskier investment. And then they are allocating a big chunk, the biggest chunk, to real estate to grow and protect that wealth. So while it may surprise the average listener or non-podcast listener that this is the allocation of what the super rich actually do, it doesn't surprise us at all, because this is what we've read, talked about and actioned ourselves over the years.
Yeah, exactly. And I'm not sure of the methodology, but my belief is that this is purely about their investments rather than any businesses that they currently operate directly. And many of the people who will have reached this level of wealth will also have a primary business that they own. I think that's separate from what we're talking about here, which means they've actually got even more exposure to business, which, as you just said, Rob, is sort of the real wealth creation mechanism here. That's the real driver. But then for real estate to have the biggest slice of the pie, no, doesn't surprise me at all. And obviously we wouldn't have done this podcast for such a long time if we weren't enthusiastic about property. But it makes even more sense for the people that we're talking about here, because when you get to the levels of sort of 20 million plus, this is a generalization, but you're probably going to be thinking about wealth preservation more than wealth creation. And these people are also thinking a lot about intergenerational wealth. These are often people who've had a huge success, they've created something out of nothing, and they want their kids and their grandkids to benefit from that. And property is probably the perfect way of achieving that. Because again, this isn't an original idea, but if you give your kids a business, they could mess it up. It's quite hard to mess up property. All you need to do is keep on holding it and collect the rent. And for all the reasons we've talked about before, because of inflation and everything else, it tends to hold its value over time. So if you're looking at preserving your wealth over the rest of your lifetime and the next 100 years beyond, what would you do, Rob? I mean, if you could put your money into any one thing and the objective is it needs to be there in 100 years' time, what would it be? It has to be property, right? I can't see anything else getting close.
Yeah, I mean, we're biased, but we also do it ourselves. That's our belief. It's not just something we talk about. We do. We invest in property because we believe in it. And if you've listened to the last however many hundreds of episodes, maybe you feel the same. And we know many of you, in fact, a massive chunk of you, do invest who listen to the podcast. So I don't think we're going to have much of a struggle here convincing you. But again, this is an opinion. This is just the data. This is really interesting because we've said this is what people do because it made most sense to us. But it's great to have this data to give you confidence that when you get to a point of wealth, that this is how you should operate. And property is a great way for you to hold wealth and acquire wealth over the long term and also help future generations as well, if that's something that motivates you.
But here's the big question, Rob. This is how the super rich invest. Let's say that you are not super rich. Should you be investing this way? This is what's working for them. Should we be replicating it? Or are they in such a different world from us that it's interesting, but not actually a guide for what you should be doing?
I think it's super interesting. And I think it's a great guide for the future. But for most people, I don't think it's quite what they should be doing. So let's take the cash example. Should you hold 13% of your wealth in cash? Well, it depends on how much wealth you've got. But if you've got, say, £1 million worth of wealth, should you be holding 130,000 of it in cash? I'd argue, depending on your lifestyle and how much your monthly expenses are, that's probably too much. Because let's say your expenses each month are £10,000. Now, I know that'll be a lot to some people, and for some people it won't be enough. Let's not judge. Let's just use these numbers for the sake of the example. But £10,000 a month for your total expenses. Then, once you put 50 grand aside as a contingency fund, or maybe 60, you're still left with another 60,000. Now, you could say, well, I'll leave that there for opportunities. But what opportunities are going to come along that are that tasty that £60,000 is going to make a difference? Probably not many, if any at all. It's only if you've got sort of big numbers, maybe 7 figures worth of cash, you're able to put aside to take advantage of opportunities that come along and move quickly, that it becomes interesting. Because you have to remember, at that sort of level, the £60,000 willing to invest, you're operating in a busy market. There are lots of people who have access to that amount of funds. I know it's a lot of money, but a lot of people do invest with that sort of amount. So the chances of seeing an incredible deal come along and you're able to transact on it quickly because you're in a unique position of having 60 grand is probably not going to happen. However, when you move to sort of 7 figures and above, opportunities coming along that are 1 million, 2 million, 5 million, there's less people playing in that field. And having some cash available to you at that point may well be an advantage and allow you to move on a deal that is stronger than normal because you're in that position. So holding a significant part of your wealth in cash for most people is a bad idea. And if you've read Rob's book, you'll understand why, or listen to our multiple podcasts on inflation, because inflation will erode that money. And you're better, once you put a contingency fund aside, to invest rather than save. So that's the first big difference for me there, Rob. The second one, though, that stands out is investing in businesses. You've made the distinction already, but I think it's important to repeat here, is there's a difference between having your own business, which you build out, and investing in other businesses. For most people, having 25% of your wealth invested in other people's businesses that aren't your own seems way, way too high for me, for the everyday person. And it's a level of risk I don't think the majority of people listening should take.
No, I think that's right. There is a big difference between having your own business and investing in other businesses. Having your own business is an incredible driver of wealth creation. But for most people, if you're looking at investing in the public stock market versus a private equity fund of some kind, let's say that the annual return from the private equity fund is 5% a year higher. I don't think it even would be that high normally. But even if it is, it's not going to make a meaningful difference to most people. But the volatility of that investment is going to be pretty significant, and potentially the illiquidity as well. So it's probably not going to make sense. I would say, though, that another factor in here about, well, how should you invest if you're not wealthy yet? I think an interesting consideration in this is, well, but what's the objective? Like, do you want to become super rich, or do you just want to be comfortable and avoid running out of money? Those are two completely different things, and you should be investing in completely different ways. There's a style of investing that can lead to a very nice life and a comfortable retirement, but it's absolutely not going to get you into the 20 million plus range. So I think you need to know, like, does that matter to you? And obviously, in an ideal world, everyone would go, yeah, well, of course I want to be that wealthy. But are you willing to swing for the fences if there's an enhanced risk that actually it's going to go horribly wrong and you end up with nothing? That's the calculation that I think we need to be thinking about here.
I think there's also something else worth pointing out, and we've said this again, but for newer listeners, it's worth repeating. You don't all need to quit your jobs today and start a business. In fact, for most people, that'll be a terrible decision to make. But you can create extra wealth on the side through different avenues. You know, the internet is an incredible thing. And there are loads of side hustles, side businesses that you can set up that you can run in your spare time and produce that extra income that can then be funneled into investments. So it's not an all or nothing thing with creating wealth. And like Rob said, maybe this super wealth isn't something that you desire, and that's fine, because for most people, they'll find a massive uplift in happiness when they can just no longer worry about bills. It's not about the private jets or the Lamborghinis. It's just, you know what? I don't have to be fearful of the gas bill this month. That is an incredible feeling, you know, to be able to put yourself in that position. And you can follow the steps of wealth creation without risking your shirt to get there. And you can have that level of financial security without going nuts. You have to still do stuff. You know, you can't just listen to podcasts and hope this all happens. But if you're prepared to put the effort in, you can get to that place. And that's brilliant. The fact that you can make small bets with your side hustles, your businesses, if you want to do that type of thing. You can invest in properties and not have to build up £100 million portfolio and have your life dramatically improved. And that's really important to remember. It's not all or nothing. There's a lot of happiness on the way. And you may decide that at one of those destination points, that's enough for you. But I think, regardless, it's fascinating to see what the super rich do. And you can then take inspiration from it. And once you understand it, it helps you make better decisions and may also inspire you as well to get to that point. But whatever point you're going through and whatever lessons you're learning, remember, all wealth, whether it's modest or massive, requires action. So make sure that you are prepared to take action. And if you do, over the long term at least, you'll do very well. It's time for Hub Extra now, the part of the show where we like to give you a bit more value. Yes, we're not done yet. And this is all backed up by the email that goes out each and every week from Property Hub. It's absolutely free to sign up and you will get the Hub Extra email, which we aim to make the most valuable email that hits your inbox each and every week. And this week we have a book, Mr. D, and you've not told me what it is yet, and I'm having a bit of a book splurge at the moment, so please do enlighten me and everyone else with the recommendation that you have.
Yeah, I will do. So have you ever had the experience at work where someone starts telling you something and they're a few minutes in and you're sitting there thinking, why are you telling me this? Or what do you want me to do with this information? Or even, I have no idea what you're talking about. Chances are that's happened to you at work before. And that's why more people should read this book, which is called The First Minute, How to Start Conversations That Get Results. And it's about business conversations specifically. And it's all about how in 1 minute, by structuring things right, you can give people the context and the information they need to understand what you're talking about and help them give you what you need. And what I really like about this book is, as you'd hope it would be given the subject matter, it's really short, it's really well structured, and it just tells you what you need to know and nothing else. And it gives you this really simple framework that you can use. So while you may wish your colleagues had read this book and you may even decide to passively aggressively buy them a copy, actually, I think everyone would benefit from reading about this, because how you are as a communicator goes such a long way to either how well you perform if it's your own business, or how quickly you can rise up the ranks if you're working in someone else's business. Communication, in particular clear communication and concise communication, goes a really long way. So if that is something that you're willing to invest an hour or two at improving at, I strongly recommend this book.
Will be ordered today, Mr. D. Hint taken. Right. That's us done for another week on the pod. We'll be back on Tuesday with Ask Rob and Rob, and of course back with the main event, the property podcast, next week. So make sure you join us for that. Until then, have fun. Take care. Bye-bye.
Bye-bye.